Let's go now to our guest and friend, Bimnet Abebe from Galaxy Trading. As always, Bimnet, welcome back to Galaxy Brains.
Thanks for having me.
So we did last week. You cautioned to our audience that Bitcoin was felt like it was at max euphoria and that it was very possible, if not likely, that a correction was incoming. We did end up getting that correction, presuming that it may be over at this point. But last Friday, Bitcoin was nearing 100K. But then over the weekend and into the beginning of this week, dipped as much as 9% down to 91.5. Now, as we record on Wednesday, November 27th, it's around 96K. But what's your reaction to that market action?
Yeah, I think it was a very healthy sort of response in the marketplace. I think things were a bit too stretched from a positioning standpoint. You could see that in funding levels. You could see that in implied vols. In addition, you just had so much good news that ended up being baked into the market with respect to the ETF options having launched. That was a positive catalyst that got priced into the market. You've had the administration Trump news. That's kind of been baked in. You had more optimism around a Bitcoin reserve or strategic stockpile, however you want to think about that. And so it was a market that was at resistance at very stretched positioning levels that really didn't have any kind of like much more near term catalysts to price in. So I think the reaction was healthy, and the subsequent price action after the correction to basically 91K has been a pretty nice rebound. And historically, that's symptomatic of an asset that is getting more institutionalized from the standpoint that institutions are the types of folks that do buy on dips. And the dip, given how much we'd run up, was very healthy. And as you've highlighted in some of your reporting, Bitcoin does tend to correct like 10 to 20% in bull markets, and so seeing a roughly 9-10% correction in Bitcoin is perfectly kind of reasonable. I would like to highlight though that you have had kind of a little dent in the monetary debasement sort of argument with the appointment of Scott Bessent. Uh, his philosophy is kind of based on a 3-3-3 plan. Get GDP growth to nominal GDP growth to sustain around 3%, 3 million more barrels of oil per day. In addition to a debt to GDP ratio of 3%. And, I think we're running close deficits that are close to like 6+% right now. And so, that all kind of uh, suggests that, Trump might be and Doge, like the government efficiency program, et cetera, that all suggests that, the fiscal path of the US might be a little bit better than what folks had anticipated. And so you saw things like gold retrace like 3+%. And so it wasn't shocking to me that, the day of or day after, you had that correction in gold, you saw something similar in Bitcoin. But broadly speaking, besides that macro kind of tailwind, the broader sort of setup in macro markets is still supportive of Bitcoin higher. Equities are trading, close to all time highs. They're in a very strong seasonal period. You do have an aggressive amount of tech stock buybacks that are continued to expected to continue to happen over the course of the next month. I think you're expected to also get a little bit more systemic flows from the fact that vol has come down in the S&P, pretty meaningfully, and so that generally leads to increased buying by CTA types, etc. And so, uh, and in terms of the Fed policy, I think it's still a coin flip whether or not they cut in the December meeting, but I'm inclined to think that they will cut, and that's the language you've heard out of the Fed. And so, you've got a Fed that's continuing its easing cycle. You've got equity markets that are trading well, and so I do think that's going to be conducive for price appreciation in crypto on a go forward.
Yep, I think that's really astute analysis. I think one thing I wanted to ask you about, there's been charts going around a lot. I made one of the global M2 versus Bitcoin price. Over a very long time frame, they look to be pretty well correlated, right? When sort of money supply contracts, Bitcoin. By the way, I think you could probably overlay like S&P on it, and it would also seem to correlate decently well. But just we just got the prints from the St. Louis Fed on the US M2, and we got China. We don't have Europe yet for the end of month October, even though I don't know why central banks need 27 days to publish this data. But anyway, it's contracting a little bit while Bitcoin has been ripping. Obviously, Bitcoin ripping for sort of idiosyncratic Bitcoin market reasons, namely the Trump victory and anticipated positive attitude. But should we take anything into that? Contracting M2 just on a month over month basis, or how should we think about that?
No, I mean, I think I would be looking at those charts, like, on a much wider time horizon, and kind of be thinking about, like, when is the Fed ultimately going to be forced to do some form of QE. I do think that the bellwether for global money is kind of the U.S. They're kind of the giant in the room. And so, what I'd be most closely watching is just, whether or not that the Fed, resumes asset purchases at some point, or does some kind of operation twist, etc. Uh, but high level, you're absolutely right. The level of money that's created in the system, the velocity of it, etc., does have an impact on risk assets. And generally speaking, when you increase the money supply, in theory, scarce resources should be worth more. Um, but yeah, I mean, if you're really thinking about the thesis behind Bitcoin, it's that over the next 10 years, M2 has nowhere else to go but higher. Right. And so if you're really thinking about it as like a decade long investment, or a multi decade investment that belongs in real institutional portfolios, I think that the trend is very clear. And ultimately, like, if the fiscal situation in the US and the rest of the world stays where it is currently, which I think it will. Like, I don't think a reduction of US debt to GDP down to 3% is feasible in our current political economy. And so if you just do the math of running deficits that are this big at these high interest rates over time, that will definitely require monetization of some of the debt that the US has. And so ultimately, I think that chart is spot on. That assets will continue to appreciate as long as that there's money being printed. So yeah, I'm a fan of that analysis, but I just think that you really have to frame it in kind of the next 5 or 10 years context.
Makes a lot of sense. Let's leave it there for now. We'll check in next week. Everybody, I hope is having a great Thanksgiving, and that you do too, my friend Bimnet Abebe from Galaxy Trading. As always, thank you so much.